Welcome to this week's episode of DoubleLine Minutes. I'm Eric Dhall here with Mark Kimbrough.
Hey.
So I think that this is pretty quiet week, but we'll keep you guys up to date. Hope all of the listeners are enjoying the coming of spring. Spring is one of those times where the weather's changing and the markets have been changing. So let's just jump right into it. Looking at the equity markets for the week as of the recording of this podcast, definitely a negative week on balance, but much less negative than the previous week. The S&P is actually up 28 basis points, but some of the high-flying sectors like technology are down. Tech is down 37 bips, and it's the second to last performer. Materials is actually down more, about 0.5%, but you could just chalk that up to volatility. Some of the best performers this week were the energy sector, up 3%. So that's pretty impressive. Healthcare is also up 1%, and financials are up a nice 2%. So some sector dispersion there in large cap US equities. And we're still kind of grinding out in this correction. I mean, off the bottom, the S&P is off the bottom. So month to date, it's down about 5%. So we're seeing some consolidation. I mean, if you look at the chart, if you're a technician, the 200-day moving average of the S&P is at 5,750, and the market's at around 5650. So consolidating below that 200-day moving average. I personally think the market's going to consolidate for a while, and we're going to get into what the Fed had to talk about, but definitely the market's in an uncertain place. Kind of moving on to non-traditional indices, looking at the Russell 1000 growth, that's down 12 bips, but the Russell 1000 value is up 100 bips. So value outperforming growth. Looking at equal weight indices have also squeaked out a positive return on a week-to-date basis. So those are up about 20 basis points. On an aside, there's a really high-flying chip maker. I'm not going to name the name so I don't get in compliance trouble, but the technicians of the world are pretty excited because, well, I don't know if they're excited, but they're worried sick because it experienced something called the death cross when the 200 moving day average and the 50-day moving average cross on kind of a declining momentum trend. And so that's something to watch. That high flyer was the darling of the markets, and now it's maybe going to become a pariah. We'll just have to wait and see. Moving on to fixed income. Fixed income was kind of much ado about nothing regarding rates. I mean, you're looking at the back end of the curve. Back end of the curve is in a couple bips. On the 30-year in 3, on the 10-year in 6. The front end of the curve hasn't moved much at all. Looking across fixed income land at the fixed income sectors, the Bloomberg aggregate's up 0.5% on the week. So nice little return there. Government bonds are up 0.5%. Corporate bonds are up about 60 bips. So are mortgage-backed securities getting a little sunshine, up 60 bips. The weaker parts of the fixed income market have been the bank loans market, which is kind of flat, and the CLO market. There's been some interesting activity in some CLO ETFs. You've seen some big dips there, some sellers, so that's something to keep an eye on. And rounding out, emerging market bonds have squeaked out about 0.25% return on the week. So positive in fixed income land, positive in rates. I wouldn't say it's a mega rally or anything, just a little bit of a small rally and stabilization. I mean, we're kind of trading in the middle of the range that rates have been over the last 2 years. So we'll just have to wait and see how things break. Kind of shifting gears to commodity land, gold, man. Gold is putting in solid prints above 3,000 as we record. It's sitting at $3,022, and it's holding those levels. So gold's definitely has luster right now. The crude oil market increased on the week. WTI crude's up about 2%, and that kind of led the energy complex up about 0.5%. When you look at industrial metals, they're also up about 0.5%. The big winner is livestock, which there's a lot of volatility, but up about 3% on the week. And the only kind of you look at like Bitcoin's down 31 bips, but Bitcoin volatility is so high. Bitcoin at around 84,000, I consider that, flat. And the dollar actually rallied this week up about 40 bips. So that kind of wraps up where we are as of the recording.
That's nice for a little stability there after this last month of vol, so we'll take that.
And investors' portfolios have been hammered by that bout of vol. So, Jay Powell kind of threaded the needle this week and put the markets at ease. But let's jump into the economics before we talk about that Fed meeting.
Yeah, let's do that. So it's pretty light week of economic data, aside from the Fed, but it starts off with a strong one with retail sales starting on Monday for the month of February. This came in with a headline number at 0.2%. That was 0.4 below the estimates and 1.4% above the prior. I'll get to that big above the prior later. The retail sales ex auto and gas that came in at 0.5%. That was 0.1% above the estimates and 1.3% above the prior. And the retail sales control group, that's the one that hits our GDP calculation, that came in at a solid 1%. That was 0.6% above estimates and a full 2% above the prior. So there's some movement here that I want to kind of try and create a narrative for you on. If we look at just retail sales this month, it was a mixed bag. The control group was a strong print, but all of these are bouncing off numbers that were rather weak in January and were revised down by anywhere from 20 to 30 bips this month. So looking at the last 6 months of data, we closed 2024 with a very strong 4 months of retail sales. Numbers were looking good, and there was a bit of an expectation of a payback to happen in January, which we did indeed see. And again, it was revised further. But this month, we got a little bit of a bounce, and it makes you wonder what that bounce means. So I want to try and talk about two categories here in particular. Actually, I'm going to start with non-store retailers. This is, online shopping. It's a 17%, 17.5% weight in the headline retail sales calculation. And this month it kicked in, it contributed a whole 43 bips, more than double what the actual print was. It was up 2.4% month over month. So very firm for online spending. And that leads me to believe why, or a question why. This was actually a reversal of last month's negative 2.4% print. So a mere reversal. And again, last month you'd expect some retrenchment. So what do you explain the current rebound, that firm rebound? Or how would you want to explain that? Could you say that, there was pent up demand from the consumer and they just were so excited to get back out there? That doesn't seem to be the case, but hey, maybe. When you're looking across the board here in the report, the other top contributors were health stores and food and beverage. Would not call those, those are those are not discretionary categories. Those are consumers going out there trying to live. On the downside, you had eating and drinking, the loan services category of the retail sales report, and that's a 13% weight, and it was down, contributed 20 bips to the negative side this month, and 1.5% negative month over month. So over the last 3 months, we've actually seen a degradation in these eating and drinking numbers. There's a cumulative. Let me get this. Over the last 3 months, this measure has pulled back a cumulative 2.2%. It's pretty weak, actually. That's not, we've been able to speak to strong services for a long time, and now it's starting to build. So if we're having a pullback in consumers heading out to spend, for eating and drinking, and they're not spending strong on their, I guess, discretionary spending, it's not really giving you much confidence in a firm retail spending numbers to start the year.
I mean, I think you make a good point, Kimbrough, but I think you have to take these numbers with a grain of salt because you got to see how the trend is. But I agree, those numbers you just stated are kind of bearish, and people are starting to tighten their belts. I think that uncertainty is the kind of the word that's in vogue these days, and people are just like, I don't know what's going to happen with tariffs. I don't know what's going to happen with the economy. And so I think it makes sense in that context that people are maybe, pulling back a little bit, but I don't think we should make a mountain out of a molehill, but I do think that this kind of sets the pieces in play for the possibility of an economic slowdown. I mean, the CEO of DoubleLine was on CNBC, and he thinks there's a 50% chance of a recession. And maybe I'm a little less, but my internal probability is a little less than that. But it's 50% is a coin flip. So you don't know what's going to happen, So you just have to. People are tightening their belts, though, and I think you make that point.
You know what I want to say? You kind of stole the words out of my mouth. I was laying the foundation there, and then wanted to pull it back because a lot of this, again, you had the pickup in spending that happened for non-store retailers, that could be tariff related. A lot of this data is experiencing volatility where it is a little, when we're getting these trending data points over this 3-month period, that covers a presidential transition period as well as 2 months of volatility of not knowing really what's going to happen. So everything you said, I fully agree with there. That's we have this data pointing that direction, but you shouldn't overreact to it because we need to see where this data continues to trend. There's a lot of uncertainty going on, as you said. Close that one up and go to import prices for Tuesday. We had, for the month of February, we had 0.4% on the headline print month over month. It was 0.4% above estimates and right in line with the prior. Not much of a development here. The import price was also, the year-over-year measure was 0.4 above estimates and 0.2 above the prior. We had a small roll off of 0.2. There was, in February, we had the 10% tariff on Chinese goods, and you did see a 0.5% increase in the price of imports from China for goods, but import prices aren't directly captured in these, tariffs are not directly captured in the import price measure here. We'll see how this responds in the months to come, but there still are not a lot of those impacts being baked into the cake here. Roll forward also on Tuesday. I'm going to give a little positivity here. We got some manufacturing related data. We have industrial production month over month for the month of February that printed at 0.7%. That was 0.5 above the estimates and 0.4 above the prior. You have capacity utilization for the month of February. That came in at 78.2%. That's 0.4 above estimates and 0.5% above the prior. And lastly, you have the manufacturing SIC production. That's excluding utilities and mining. That came in at a firm 0.9%. That was 0.6% above estimates and 0.8% above the prior. Just quick on this starting to, the data, there's more data starting to stack up that kind of supports the manufacturing thaw. I do want to jump ahead and just say some of this could be impacted by tariffs and there can be some volatility. So we don't want to overestimate or over extrapolate the trend, but let's take a couple stats here. I'm going to use this 3-month cumulative sort of number to see where we've started in this transition period. In the last 3 months, the headline industrial production has grown by 2.14%. That's the fastest. That's not annualized. That's just 3 months. That's the fastest since December of 2021. This is happening while we've had back-to-back months of both ISM and S&P Global PMIs coming in north of 50. And to front run next week, we're estimated to get another 50 print. On the SIC production, this just printed a 1-year high of 87 bips. That was the 0.9%. And its 3-month cumulative growth rate was 1.43%. That's the fastest since April of 2022. And lastly, we just got the second highest print for capacity utilization in the last 15 months. So not the all clear for manufacturing, but this is all positive developments. And when you bake in some protectionist trade policies and that, are bent to support domestic manufacturers, you could maybe create an argument to see why this could persist. But again, we need to be cognizant of the tariffs and the volatility that's going on. So this is still positive, I will say, though. On Wednesday, not going to dive into details. We had FOMC. The rate was unchanged. We'll talk about that later. On Thursday, we get initial jobless claims for the week ending March 15th and continuing claims for the week ending March 8th. Just stay steady as she drifts. I'll run the numbers for you real quick. It's initial claims printed 223K. That was 1K below estimates, 3K above the prior. Still range bound. And continuing claims printed 1.892 million. That was 5K above the above the estimates, and 22K above the prior. We're still hanging below that 1.9 million high water mark from Jan. Leave that be, and we'll go to leading economic index also on Thursday.
The broken clock.
Yeah, the broken clock reset itself, and I got some fun color on that. So for February, our month over month print came in at negative 0.3%. That was slightly below the estimates of negative 0.2%, and also below the prior of negative 0.2%. So last month, I remember we were talking about this, and the LEI, they've got their recession signal and warning signals. And last month, it was nice that we saw that both December and January, they were no longer giving a warning signal. They have two conditions, basically. If there's a diffusion index and a 6-month annualized growth rate, if you're below the growth rate level and your diffusion is below 50, that gives you a recession indicator. If only one of those is triggered, you get a warning. And last month, it was nice to see that the LEI had removed the warning signals for December and January. They have unfortunately revised the data, and the warning signals are back on for December, January, and for February. So they're no longer trying to give us a little comforting feeling going into the new year here. But Yeah, that's where LEI is sitting right now. Call it a warning, and that wraps up the week of economic data.
Yeah, I mean, I definitely think by far the most important thing that happened this week was the Fed meeting,
Oh yeah,
even though there was nothing that really happened. So, like I said earlier in this podcast, I think this was a all quiet on the Western Front type of a week, so to speak, of consolidation and just consolidating around uncertainty, with the asset repricing we saw 2 weeks ago, kind of just consolidating. I mean, I think that there was an excellent interview with the CEO of DoubleLine and Scott Wapner of CNBC. Check that out on our YouTube channel. But I'm pretty aligned with the views of the firm on and the views of Mr. Gunlock regarding that Fed meeting. And I mean, the market still. You look at the interest rate probabilities. You got 3 cuts priced in by year end. I don't know about that. I mean, you look at the dot plots, and the dot plots are this weird kind of like the dots being the summary of economic projections, and all the Federal Reserve members go and they say where they think rates are going to be at different points in the year and how the economy is going to be and how inflation is going to be. And what I found interesting is like you have less doves in the dot plot, so less
yeah,
Federal Reserve members thinking they're going to cut more than 2 times. And at the same time, they're predicting that economic growth is going to slow to like 1.7 or 1.8. And at the same time, they think that inflation might be going up. And I don't think they really know what's going to happen right now. Frankly, I think they're a little befuddled, and they're just, you know, over and over again in the press conference, Jay Powell was making references to like, if you don't know what's going to happen, you just kind of have to steady as she drifts, so to speak. So I don't, that was my interpretation of the Fed's meeting and Jay's comments. I do think the market liked it, and the market was kind of more in a sanguine mood after kind of digesting his commentary. But I don't really know if there's more to glean from the tea leaves there. I mean, it's just we're kind of stuck in this situation. We have to wait and see until the next kind of tariff date, which is April 2nd, pops up. What do you think, Kimbrough?
I mean, I'm pretty much aligned there. I mean, it's said this last Fed meeting, and it was repeated again. This Jeffrey mentioned it on CNBC. I mean, the frequency of the use of the word uncertainty, it almost sounds like transitory. I mean, it's the new buzzword. And uncertainty makes sense. The market was itching for a reason to, try and rally, and we didn't get anything that terrible from Powell. I mean, he said things are somewhat uncertain. They're trying to kind of look through some of the impacts of these tariffs because it's just they don't know. Um, there was a positive development you could say is the change in QT. We had the monthly cap
Yeah,
for
that's a good
treasuries.
point. It's a good point.
It's a long way we've come since the 60 billion cap. It was 25, and now it's cut to 5. So the balance sheet can stabilize, and that arguably is a little bit of a tailwind or a removal of a headwind for the bond market. So little support there. But what's I mean, it still is a rounding error. It's a drop in the bucket, but it's something.
Yeah, I think that's a good point. I mean, it isn't a huge thing, but it's like a incrementally dovish development. In my opinion, it's
Yeah,
increasing liquidity in the system because we're not gonna. Maybe this will be a topic of the week sometime, but to talk about the plumbing of how QT removes liquidity from the banking system, and by reducing the amount of QT, you're increasing liquidity. So I think technically it is a dovish move. It's tough to argue that it isn't a dovish move, but that's
yeah.
that kind of so it's incrementally dovish, but rates have remained unchanged, and the Fed's kind of in a wait and hold mode. And let's kind of get through next week is a big week. We got a lot of things dropping, Kimbrough.
It does. I front ran Monday a little bit. We had S&P Global, the PMI numbers for the US for March. We got the manufacturing number estimated to come in at 51.5. That'll be our third consecutive month above 50 if we can get that print versus a prior of 52.7. You got the services PMI coming in at 50.9 on the estimate. That keeps us, I think it's just about our 2-year trend of, no, almost a 2-year trend of us staying in expansion territory. What else we got here? I lost my screen place for a second. There we go. We got on Tuesday the S&P CoreLogic 20 city measure month over month. We got home prices here estimated to come in at plus 35 bips. And steady she drift for home prices. We'll see where that comes. On Tuesday, we also have conference board consumer confidence measures. That's estimated to come in at 94. That actually is interesting. We've been range bound for this measure since 2022, and this would break to a low that we have not seen since Jan of 2021. So on the conference, board consumer confidence, we'll see how that develops. Also on Wednesday, we have more manufacturing data, related data. This is the durable goods orders, durable X transportation, cap goods orders, and shipments. The durable goods orders is estimated for February to come in at -1%. That's 4.2% below the prior. It's a volatile category. It's going to be transportation related, aircraft related. Durables X transportation estimated to come in at 0.2%. That's 0.2 above the prior. And the cap goods orders estimated to be flat versus 0.8%. So not much strength to be seen there on the estimates, but we'll see what actually comes in the prints. On Thursday, we get the third estimate for Q4 GDP. It's estimated to inch up from 2.3% to 2.4%. On Thursday, we also have initial jobless claims and continuing claims. Steady she drifts for those. We got a 225K estimate for initial claims. And on Friday, we get personal income and spending. Nice bounce for spending and income coming in stable. We have a 0.4% estimate for income and a 0.5% estimate for spending. The mental bogeys for those like to use is just under 0.4%. That's their 20-year trailing average. And lastly, on Friday, you get PCE data, the most important inflation data. The headline number month over month is expected to come in for February at 0.3%. It's right in line with the prior. The year over year also would be coming in right in line with the prior at 2.5% on the estimate. And the core number, the month over month, is estimated to come in at 0.3%, right in line with the prior, while the year over year number is expected to inch up to 2.7% versus a prior of 2.6. Got a small roll off this month for core of 0.24. We'll see what we get, but kind of treading water for these core PCE numbers in the mid to high twos range. And that wraps up what we got on deck for next week.
Yeah, stay tuned for that PCE data that comes out. Definitely going to be a market moving event, and see what happens. And that kind of wraps it up for the week.
Yes, thanks out there to all our listeners today on DL Minutes. Hit us up on the X at DL Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
Yep, you can find more information about DoubleLine on our website, doubleline.com. Don't forget to subscribe to our YouTube channel at youtube.com/doublelinecapital, and check out the latest interview of Jeffrey Gunlock on CNBC. It just got posted. Definitely worth a watch. And I think that wraps it up. Thanks for tuning in, and I hope everyone has a great weekend.
Yeah, thanks to our listeners out there. Stay safe.
This presentation was recorded on the date indicated. Views and opinions expressed herein are those of the individual and do not necessarily reflect the views of DoubleLine Capital LP, its affiliates, or employees.